Lemonade reported their quarterly figures yesterday after hours. Was a pretty solid report. Guidance was a bit weak, and so the stock got punished. It was down 15-17% or so at one point. At the time of making this video, it's down 12.13%. Still has a market cap of 1.5 billion dollars. Year to date, still up considerably compared to what it has done before. Still down 74% or so in the last 3 years. But overall, the business itself is doing better quarter after quarter. The big bearish points, which were one, they're running out of money, they're going to go bankrupt, or they have to raise money and dilute shareholder even further. And two, they're small fish in a huge, huge ocean, they will never make it. So far, they are making it. And there was a surprise in this quarter as well. Overall, in my opinion, still a solid quarter, maybe some bumps here and there on the road, but that's about it. We're going to review that. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate it. We're going to review a lot of earnings reports in the coming days and weeks. So make sure you hit that notification bell so you don't miss any videos. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's go over the main figures first. So in-force premium came in at $839 million. That's up 22% year over year. Premium per customer is up 8% year over year. Total customers has increased 14% year over year to now 2,167,194. And gross loss ratio is down 15% year over year to 79% despite the catastrophic events. And so for this quarter, we've got net cash flow. We were net cash flow positive in Q2 2024 and expect to remain net cash flow positive with the exception of Q4 2024. Net cash flow in the quarter was $4 million compared to a loss here of $51 million same quarter a year ago. As for gross profit, that increased 155% year over year, while gross profit margin doubled year on year to 25%. Operating expense only increased 13% year over year, or $12 million year on year, primarily driven by a $13 million increase in growth spend, while all other operating expense was stable as compared to the prior year. Bottom line, still a loss here from an adjusted EBITDA standpoint, but that did improve 18% year on year. Now, they do focus a little bit more in that shareholder letter on the cash flow positive aspect of things and why that's more important than earnings and stuff like that, especially for an insurance business. So they say here that Q2 was net cash flow positive, and we expect to remain net cash flow positive moving forward with the exception of Q4 due to seasonal cash flow patterns. From our current balance of $931 million, we expect our cash and investment balance to dip by approximately 1 to 2% before consistently climbing. Cash flow is of unique importance to us for a number of reasons. In many industries, cash flows lag earnings. In insurance, however, cash flow precedes earnings as premiums are paid before claims are. Therefore, for Lemonade, cash flow is a leading indicator, providing management and investors with a more current picture of our model's benefits and a first look at our business fundamentals as they develop. Unlike the P&L, the cash flow statement captures the layered impact of our growth spend, where 80% of our spend is financed by our synthetic agents partners. This dramatic feature of our business is largely missed in a P&L-centric view. And so, net cash flow is a key metric for Lemonade. We invest in profitable growth as measured by a healthy LTV to CAC ratio to maximize long-term cash flow. While this may reduce short-term profitability, reinvesting excess cash into growth directly drives enterprise value, which I certainly agree with because Lemonade's still a young company. There's no reason to suddenly focus only on earnings right now. If you have cash flow, reinvest that in the business to grow even faster. It's definitely going to benefit the long-term health of the company. Now, switching to loss ratio, while Q2 saw a surge in natural catastrophe events across the industry, driving elevated losses for many carriers, our 79% gross loss ratio result was notably stable. Now, and here is the thing where we should be focusing a little bit more on, and it becomes more apparent this quarter that they are focusing a lot on pet and renters and less on homeowners, at least in the United States. So they say here, growing products with lower cat exposure, notably pet and renters, geographic consideration when it comes to homeowners growth, including diversification via Europe, continuing to sell Lemonade homeowners policies only where our AI-powered LTV models predict attractive unit economics. And they say here they've begun non-renewing certain cat-exposed homeowners policies that we would not underwrite today given what our AI-powered LTV models have learned. This effort will ramp up considerably in the second half of 2024, impacting in-force premiums by roughly $20 to $25 million, which is built into our guidance. Of course, this helps with the profitability side of the business, and as Lemonade grows and become more and more profitable, they will probably not mind having extra risk by exposing themselves to more homeowners. And so right now, this definitely helps with operational efficiencies. If you look at year-over-year improvements in gross loss ratio, that is quite something. Of course, we're not done yet. If you look at in-force premium versus operating expense, excluding growth spend, and in-force premium per headcount, all going into the right direction. They say over the past 2 years, CAGR of in-force premiums was at 35%. It's more than 3x the CAGR of operating expense at 11%. Now look, I get it. They are professionals at writing nice words in the shareholder letter each and every quarter, telling us that everything is great and fine. Okay, but realistically speaking, is there something negative going on here? Despite maybe a bump here, a bump there. Overall, I think the thesis is playing out. And to be honest, playing out a bit faster than expected, right? Profitability-wise, cash flow-wise, it's all a bit earlier than expected. Yes, maybe growth was not as great as previously thought. But if they can become more and more profitable sooner than expected, don't you think that they can spend more to grow faster afterwards? I think that's the plan, and I think that's what's going to happen. Again, guidance is probably the reason why the stock has taken a hit, so let's look at that. This year, we expect familiar seasonal patterns to repeat in Q3 and Q4, with accelerating growth spend in Q3 expected to be 3x prior year amount, and lower loss ratios in Q4, leading to the following expectations. So for the next quarter, Q3, they expect in-force premium to grow around 22% year over year, gross earned premium around 21% year over year, and revenue to grow only 10% year over year, while adjusted EBITDA loss to increase quarter over quarter, loss here between $58 to $56 million. As for the full year, they expect in-force premium to grow around 26% year over year, gross earned premium around 22%, and revenue around 20%. Usually, we are more familiar with them raising guidance. Right now, they did not raise guidance, but at least we've got net cash flow positive. So I'll take that. Plus, a lot can change in Q3, in Q4. Guidance might be raised, might also not be raised. That remains to be seen. But so far, this is the picture. This is what the company is doing right now. This is what the company has been doing in the last 3 months. And I like what I'm seeing. If the stock takes a big hit, so be it. And so right now, looking at the stock, like I said, since the start of July, it did go up close to 50%. Of course, now pre-market, we are a bit lower. We're still around the 20-day moving average. The 200-day one sits at $17.26, the 50-day one at $18.82. When we were closer to $24 or so, RSI was pretty close to being overbought. Not anymore, and with the dip that is expected to come right now, probably RSI is going to go down a little bit more. But overall, lots of people are panicking just because they're looking at the stock and not because they actually look at what the business has been doing, what the business is expected to do going forward. My opinion, that's just a flawed way to look at things. That's just my opinion. If we drop more, I will increase my position because I want my average to come down more and more. So that's about it. That's my opinion. That's what I will be doing. Leave your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.